Welcome to the deep dive. Today, we're looking at something pretty fascinating. The intersection of two completely different worlds. You've got the blinding speed of AI development, right?
Yeah.
Exponential growth.
Oh, yeah, just incredibly fast.
And then you have the world of utility infrastructure, which is, deeply regulated, traditionally pretty slow-moving.
Right. Decades-long planning cycles, typically.
Exactly. So we're analyzing how this massive energy demand from AI is creating this, well, unprecedented investment opportunity, really, for a company you might not immediately connect with cutting-edge tech. We're talking about Berkshire Hathaway.
Yeah, most people think insurance, railroads, maybe See's Candies.
Right. But we're zoning in on their utility subsidiary, Berkshire Hathaway Energy, or BHE. And if your image of a utility is sort of sleepy, predictable, maybe a bit boring.
Yeah, the classic widows and orphans stock.
You need to rethink that here. Our analysis suggests BHE is actually morphing into this high CapEx, almost high-speed infrastructure player. They're the ones literally putting the power lines in the ground, building the capacity that the world's biggest tech companies absolutely need.
That's really the heart of it. Our mission today is to explain the sort of structural forces behind this energy surge. And importantly, the financial setup, this regulated utility model, that basically guarantees BHE makes money on all this massive investment.
And where this is all happening, geographically.
Exactly. Where are the hot spots? This is really the story of how power grids kind of unexpectedly became this critical low-risk choke point for the whole AI revolution.
Okay, so let's really unpack this structural shock.
Yeah.
Because the amount of power we're talking about, it's just completely changing how utilities have to plan things.
It really is. The growth isn't linear, it's exponential. So the old forecasting models, they don't really cut it anymore.
We saw some data, just some huge forecasts for new power needed just for generative AI models, even short-term, right? Internal estimates are suggesting that just training the latest AI models, that alone is expected to need something like 50 gigawatts of new power capacity globally by 2027.
Which is, practically tomorrow in utility terms. 50 gigawatts is enormous.
And that's just training. If you zoom out, look longer term.
Oh, the numbers become, well, almost unbelievable. We found research projecting that U.S. power demand just from AI data centers, it could jump more than 30 times.
30-fold.
Yeah, from about 4 gigawatts now, maybe, to potentially 123 gigawatts by 2035. It's like adding a whole new industrial sector onto the grid, on a grid that's, frankly, aging.
And it's not just the sheer amount of power, right? It's how it's being used, the density.
That's the critical point. It's the density that really stresses the local grid in a way traditional factories, for example, don't.
Explain that density a bit more. We need to get into these hyperscalers, right? The Amazons, Microsofts, Googles.
Precisely. Yeah. So historically, data centers weren't that power dense. But AI, it runs on different hardware. Yeah. Specialized GPUs, graphical processing units, not the standard CPUs.
And those GPUs are power hogs.
Huge power hogs. They need dramatically more energy per square foot. So think about it like this. Some sources gave an example where, say, a 5-acre data center might use 5 megawatts today, standard stuff.
Okay.
But then you upgrade it for heavy-duty AI processing. That same 5-acre footprint could suddenly demand 50 megawatts. A 10-fold jump in density.
Wow. Okay.
So localized demand just skyrockets. And McKinsey estimated that AI, it's going to be responsible for maybe 70% of all new data center power demand between now and 2030.
70%, even though it's a smaller part of the current load.
Exactly. That kind of concentrated high-density demand puts incredible strain on local substations, local lines, stuff that just wasn't built for that kind of load.
And that intense demand, that density problem, it really highlights the industry's big weakness, which kind of ironically becomes BHE's strength.
Yeah, the immediate problem for everyone isn't always generating more power somewhere far away.
It's getting it to the specific data center that needs it right now.
Exactly. We're hitting what you call the T&D bottleneck, transmission and distribution.
Right, let's define that. T&D. Transmission is the big high-voltage lines carrying power cross-country. Distribution is the local network, the poles and wires in your neighborhood, essentially.
In building new high-voltage transmission, getting permits, land rights, that takes years. Often, building a huge solar farm out in the desert is actually faster than getting the approvals to build the power lines needed to connect a new data center.
We heard competitors are facing delays like 7 years or even more sometimes just to get connected.
Easily. And that multi-year delay, that is BHE's competitive moat. They already control this enormous network, 215,000 circuit miles of lines?
Huge scale.
Huge scale. Plus, they have the financial clout, the experience navigating regulations to speed up those critical grid connections.
Yeah.
For a hyperscaler, on a tight AI deadline, getting connected fast is worth a lot more than saving a tiny fraction on the per kilowatt-hour cost. Speed is everything.
Okay, so that's the physical advantage. Now let's talk money, the financial engine here. Because this required infrastructure build-out becomes incredibly attractive for Berkshire Hathaway because of the regulated utility model. It basically lets them turn that famous cash pile into a profit-generating machine, almost guaranteed.
It really does. It hinges on the rate base.
Explain the rate base. It's central to this whole story.
Okay, think of it simply. A regulated utility gets a monopoly in its service area. In return, it has an obligation to provide power to everyone who needs it reliably.
Okay, the obligation to serve.
Right. Now, every dollar they invest in necessary infrastructure, new lines, substations, power plants, renewables, if the state regulators approve it as prudent and necessary, that investment gets added to their rate base.
Like a running tally of approved assets.
Exactly. And the utility is then legally allowed to earn a stable, regulated rate of return on that rate base, usually somewhere around, say, 9 or 10%, year after year.
So it's almost like a government-sanctioned mortgage on essential infrastructure.
That's a pretty good analogy. It's long-term, very stable. And here's the key. These shockingly large increases in AI demand, as Berkshire calls them, they mandate billions in new capex. BHE has to build this stuff to meet demand.
So the spending isn't optional.
Not if they want to meet their obligation. So this mandatory spending automatically grows the rate base. It turns Berkshire's massive cash reserves, which might otherwise earn less, into these long-duration, interest-bearing assets with regulator-approved profit margins. It's almost tailor-made for Berkshire's capital allocation strategy.
But doesn't that guaranteed return, maybe encourage gold plating, spending too much, or create political problems if rates go up for everyone?
That's the inherent tension, always. The spending does have to be approved by state commissions as prudent. They scrutinize it. But the sheer necessity driven by this AI demand wave, it makes the case for spending much stronger. The need is undeniable.
Okay.
But you're right about the politics. Who pays for it? That's a huge issue, and we'll definitely get into that more when we talk about the challenges later on. Managing that is crucial.
Right, so this financial opportunity isn't spread evenly. It's really concentrated where BHE operates and where these tech giants are clustering. Let's look at the hotspots. Starting down in Nevada, NV Energy's territory. This sounds like, well, a crisis almost. The tripling demand crisis is.
It's pretty dramatic language, but the numbers back it up. NV Energy's current peak load, the highest demand they see usually on a hot summer day, is around 9,000 megawatts.
Okay, 9,000 milliUW.
But according to internal utility figures, tech companies have already put in requests for connections totaling an additional 21,000 to 22,000 megawatts.
Yeah, wait, additional on top of the 9,000.
On top of the 9,000. So yeah, you're talking about potentially tripling the peak demand on their entire system, almost overnight, in utility planning terms.
That's insane. How do they even cope with that?
Well, that's why BHE is pouring billions into projects like the Green Lake expansion. It's designed to add 5,000 milliUW of capacity. Some of it should be online by 2027, but it's a race against time.
And it brings back that who pays question, right? If you need billions for tech companies, do grandma's rates go up?
Exactly the problem. Historically, the cost of big upgrades needed for one huge customer often got spread across all customers in the rates.
Which doesn't feel fair if it's for, a giant profitable data center.
Right. It creates public and regulatory friction. But this is where NV Energy got innovative.
Okay, what did they do?
They worked with partners like Google and also a geothermal company called Fervo Energy, and they pioneered something called the Clean Transition Tariff, or CTT.
Clean Transition Tariff, okay.
Essentially, it allows these huge corporate customers, the hyperscalers, to voluntarily pay a premium price.
A premium? Why would they do that?
Because in return, they get firm, reliable, specialized power, often from brand new, cutting-edge clean energy sources like the geothermal Fervo is developing. And critically, this CTT structure shifts the cost and the risk of developing and deploying these new technologies directly onto the corporate customer who's demanding it.
So it bypasses the regular ratepayer base.
Exactly. It protects residential customers, it de-risks the big investment for the utility, and it helps the tech giants meet their own aggressive goals for 247 carbon-free energy. It aligns everyone's interests. Pretty clever, really.
That is clever. A regulatory fix unlocking investment. Okay, now let's shift gears to the Midwest. Iowa. Mid-American Energy's territory. Quieter maybe, but a big AI hub too.
Oh, yeah. Iowa's become surprisingly central. You've got major infrastructure there, like the Microsoft Azure supercomputer near Des Moines that was reportedly used for training GPT-4.
Right. It's a serious computing happening.
Absolutely. And the projected demand growth there is also eye-popping. They expect demand related to data centers to double by the mid-2030s.
Doubling. Still huge, even if not tripling like Nevada.
It's incredibly fast growth. Greg Abel, who runs BHE, put it in perspective. He said it took Mid-American over 100 years to reach its current level of energy consumption.
A century.
And now they're looking at adding that same amount of demand again in just over a decade. That guarantees massive mandatory CapEx for Mid-American, which, again, feeds right back into that REIT-based growth and guaranteed returns for Berkshire.
Okay, so the growth picture looks, well, almost too good to be true in some ways, but obviously there are challenges. BHE has to navigate some tricky stuff to keep this engine running smoothly. Let's revisit that regulatory risk.
Yeah, it's always there. Even with things like the CTT, there's still a public perception issue, especially in places like Iowa. The concern is that these giant profitable tech companies are benefiting from infrastructure upgrades that were maybe originally justified for the public good.
The idea that regular folks are subsidizing big tech's energy appetite.
Right. So BHE has to be really careful about demonstrating fair cost allocation. That often means pushing tech companies to directly pay for, or at least significantly share in the cost of, the specific grid upgrades they require. If they don't manage that perception, they risk pushback from regulators, maybe lower allowed returns. It's a constant balancing act.
Makes sense. Beyond the regulatory side, what about physical limits, environmental constraints? You mentioned water earlier, especially out west.
Water is a huge one, particularly for Nevada. Data centers, especially using certain cooling methods, use enormous amounts of water. Hundreds of millions of gallons a year, potentially.
And Nevada is, well, it's the desert. The Colorado River Basin has serious water scarcity issues.
Exactly. That scarcity puts a very real cap on how much more data center growth the region can actually support, regardless of power availability. There was even an effort, though it failed for now, to ban the most water-intensive types of cooling centers there in 2024.
So the water risk is severe.
It is. And it actually influences where companies might choose to build next. It potentially makes a place like Iowa, Mid-American's territory, relatively more attractive because water is generally more plentiful there. So you see this interesting dynamic where an environmental constraint in one BHE territory might actually steer investment towards another BHE territory.
Fascinating internal dynamic. Okay, so facing these challenges, how is BHE positioning itself? It seems like they're trying to get ahead of the clean energy demands from these tech giants.
They absolutely are. It's a core part of their strategy. They're actively retiring coal plants, another 15 scheduled to close between 2025 and 2030. And they've really ramped up their non-carbon generation. It's already about 45% of their total capacity.
Which aligns perfectly with what Google, Microsoft, Amazon are demanding, right? That 247 carbon-free energy.
Precisely. They need their utility partners to be moving aggressively on clean energy to meet their own corporate sustainability pledges. BHE delivering on that is a major competitive advantage.
And this leads to maybe their most interesting forward-looking move, vertical integration.
Yeah, this is really compelling. So to get true 24/7 reliability from intermittent sources like solar and wind, you need massive energy storage. Batteries, big ones.
Battery energy storage systems, BESS, okay?
And what's the key ingredient for most large-scale batteries right now? Lithium.
Right. So instead of just being a customer buying batteries or buying lithium on the open market, BHE is getting into the lithium business itself.
Exactly. Their subsidiary, BHE Renewables, is actively developing projects in California's Imperial Valley to extract lithium carbonate directly from geothermal brine.
Geothermal brine, so the hot, salty water that comes up from geothermal power plants.
That's the one. It's a byproduct that happens to be rich in lithium. This is potentially a huge differentiator. They're securing a critical piece of their own supply chain for the battery storage they absolutely need to build.
And presumably it's a more environmentally friendly way to get lithium than traditional mining.
That's the argument, yes. Lower impact. So they're solving their storage problem, securing the supply chain, and doing it intentionally more sustainably. It really locks in their ability to provide that firm 2047 clean power that AI needs. It connects generation, transmission, distribution, and now even the key storage component. Very strategic. #TagNacOutro.
So when you step back and look at the big picture, what does this all mean for someone trying to grasp the AI revolution? Berkshire Hathaway, maybe seen as old economy, is actually deeply involved, but not by betting on, say, the hottest new chip designer or software startup.
No, their exposure is much more fundamental. They're acting as the indispensable, low-risk, wide-moat infrastructure provider. They're building the actual foundation the entire AI ecosystem runs on. It's a unique, lower volatility way to participate in this exponential tech growth.
The ultimate pick and shovel play, maybe, for the AI gold rush.
You could definitely see it that way. At the end of the day, this race for AI compute power, it really boiled down to a race for reliable electricity. And if the bottleneck, the thing that takes years to overcome, is infrastructure capacity, especially transmission and distribution, then it raises a big question for you, the listener, to think about.
Okay, what's that?
How much will access to these huge, stable, financially strong utility grids, like the ones BHE controls, actually dictate where the next decade of technological leadership emerges? Which regions, which countries will lead based purely on who can supply the power fastest? Infrastructure might be destiny here.
That's a powerful thought. The geography of technology being reshaped not just by talent or capital, but by access to power lines. It really highlights these unexpected ripple effects of massive tech growth hitting seemingly stable older industries. They're becoming the critical foundation.
Absolutely.
Something to definitely keep an eye on. Thanks for diving up with us today.